Ladies and gentlemen, good day and welcome to the Q2 and FY24 earnings conference call of Lumax Industries Limited. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Jain, Chairman and Managing Director of Lumax Industries Limited. Thank you, and over to you.
Good morning, everyone. Let me at the outset wish everyone on this call a very prosperous and festive Deepavali season. Along with me on this call today from Lumax Group, I have Anmol Jain, the Joint Managing Director, Mr. Sanjay Mehta, Mr. Naval Khanna, Mr. Ravi Telpia, and Ankit Thakral from the Finance and Taxation, and Ms. Priyanka Sharma from Corporate Communication, along with SGA, our Investor Relations Advisors. The results and the investor presentations have been uploaded on the Stock Exchange and company's website, and I do hope everybody has an opportunity to go through the same. In terms of the industry landscape, post the COVID recovery in the automotive sector, it has been quite remarkable. There has been a notable shift towards indigenous manufacturing to mitigate supply chain risks, and the government support has also played a commendable role, like initiatives of FAME subsidy promoting green mobility solutions. The contribution of the Indian auto industry to the country's progress is also developing cannot be overstated, as the auto component industry has actually put in a record revenue of $50 billion. The most recent development in the industry has been also the commencement of Bharat NCAP. This will further raise consumer awareness on safety issues and push auto manufacturers to prioritize customer safety and security, and also enhance the overall stability and demand in the industry. Speaking of the quarterly update, the growth of the economy has been quite robust and has been visible by strong GST collections, robust manufacturing volumes, high credit growth, and cooling of inflation. The GDP growth is expected to surpass 6.5% for the quarter. Coming to the performance of the industry, PVs are outshining with volumes touching high every month on back of robust demand, especially in utility vehicles, which are outperforming sedans. Consumers are now preferring comfort and luxury and are also ready to spend more with a rising disposable income. The two-wheeler segment is undergoing a recovery driven by two primary factors. Firstly, it is the demand for the higher CC models, with several brands launching premium options. And secondly, it's a shift towards the EV, which is contributing to the resurgence. We also believe that players with advanced manufacturing capabilities and technological innovations will eventually capture a larger share of the market. On the automotive lighting industry, the industry is largely sector agnostic. Its inherent diversity ensures that even if one segment experiences limited demand visibility, it is balanced out by the other sector. Lighting solutions are essential across all segments of the auto industry and also are becoming a safety element. The industry is witnessing a noteworthy shift through LED from conventional lighting technologies, and this transition is also having multiple factors of efficiency, longevity of LEDs as compared to its traditional counterparts. The LED lighting offers basically better, brighter illumination on the roads and also helps basically safety. The design flexibility on LED technology will also give more actually diverse aesthetic appeal on the vehicle itself. I would like to highlight that we have commenced commercial production of a new Chakan plant on 1st November for the phase 1. This plant will primarily be catering to the new business received from Mahindra and Tata Motors, and will add significant revenue and margins going forward. It will also continue to solidify our position in the industry as we are able to basically deliver more technological related products, We actually, on the last basically order book front, the company has had a healthy order book of 2,200 crores, out of which 62% is new businesses, and the EV contribution is 34% of the total order book. Now, for the financial updates, let me hand it over to Mr. Sanjay Mehta, the Group CFO.
Good morning, everyone. I will update on the operational and financial performance for the Q2 and FY H124. The share of LED lighting for the half year stands at 36% and conventional lighting at 64%. With respect to segment mix as a percentage of revenue, 66% from passenger vehicles, 29% from two-wheelers, and 5% from commercial vehicles for H1 FY24. With respect to product mix for H1 FY24 as a percentage of total revenue, 66% of revenue is from front lighting, 25% from rear lighting, and 9% from others. On the financial performance, I am delighted to say that in Q2 FY24, our revenue stands at 644 crores, a growth of 4% on year-on-year basis. Revenue for H1 FY24 is at 1,262 crores, growing at the rate of 12% year-on-year. Revenue for H1 FY24 manufacturing business has grown by 11% and molds revenue by 46% compared to previous year. The company recorded consolidated EBITDA of 111 crores with a margin of 8.8% in H1 FY24 as against 112 crores in H1 FY23. PBT before exceptional expenses and share of associates is 48 crores in H1 FY24 versus rupees 60 crores in H1 FY23. The profit after tax and share of associates stood at rupees 49 crores for H1 FY24 versus rupees 53 crores in H1 FY23. The capex incurred during the half year is 21 crores. The estimated capex for FY24 including Chakan new plant is from 250 CR to 300 CR. With this, we can open the floor for question and answer.
Thank you very much. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Mr. Abhishek from Dolat Capital. Please go ahead, sir.
Good morning, everyone, and thanks for the opportunity. Sir, revenue growth was only 4% quarter-on-quarter and year-on-year. So what is the reason for the underperformance in this quarter? Is it because of the shift in mix towards the SUV segment?
Could you just repeat the last part of your question? I understood you said 4% quarter-on-quarter, and I didn't get the last part of your question.
So underperformance of in this quarter is because of the shift in mix towards SUV segment where you have a lesser presence?
So there are a couple of things. I think if you look at the industry growth, of course, Maruti Suzuki, and I'm talking now for H1, not specifically for Q2. In H1, our manufacturing revenues have grown by 11%. But if you look at certain customer mix, Maruti Suzuki along with SMG has actually had a flat growth in H1 in terms of their production numbers across all model mix. Also, HMSI has had a negative 5% growth in their production numbers from H1 last year versus H1 this year. And Mahindra & Mahindra is the only customer which their own growth has actually happened about 22%. And in line with that, our revenue growth on a H1 basis is also 33% on account of Mahindra. So overall, as an industry, if you see, we are fairly in line with the industry growth. 2% is broadly the industry growth on a H1 basis. And against that, we've done about 11% manufacturing revenue growth.
Okay, sir. so you had a guidance of the 20 to 25% revenue growth in FY25. So do you maintain your guidance, and can we expect a sharp growth in the second half FY24 onwards?
Yes, absolutely. I think in H2 we are expecting a very handsome growth, probably upwards of 20%, because we have already commissioned our new Jharkhand facility, which will give us incremental revenues for H2, and we are sitting on a very healthy order book. Peak of that, we are sitting on almost 2,200 crores of order book, and almost 60% of that will get into SOP in FY25. So that's the reason for FY25, we are still bullish on a very handsome revenue growth outlook.
So how much incremental revenue can we expect in the second half from the Pune plant and FY25 as well?
So approximately, as I mentioned, we should be looking at around 20% to 25% growth in H2 for the company overall, and majority of this incremental revenue growth will come from the new facility in Jharkhand.
And what would be the absolute number, sir?
It will be approximately between 150 to 180-90 crores for H2 from the new facility.
Okay, sir. And my last question on your order book, around 80% order book into the LED side, which is a very high ASP product. So can we assume that your growth in FY25 would be the 2 or 2.5 times higher than the industry growth?
So as I said, the order book of 2,200 crores, almost, yes, 80% plus of it is in LED, and almost 60% of this order book will get into FY25 revenues. So we do expect a good growth in FY25 as well. I mean, giving you the specific numbers, we are looking at almost some 1,300 crores of order book, which will get into FY25. And out of this, approximately, I would say, maybe 800 to 900 crores would be new orders, not replacement orders. So that will obviously have a incremental impact on the revenue, apart from whatever organic growth which will continue into FY25 from this year onwards.
Thanks, sir. That's all from my side.
Thank you.
Thank you, sir. We take the next question from the line of Pooja Shah from Bright Securities. Please go ahead. Ms. Pooja, your line is in the talk mode. Please go ahead with your question.
Hello. Hello, can you hear me?
Yes, ma'am, we can hear you. Please go ahead with the question.
Am I audible?
Yes.
Yeah. So I wanted to ask, our share of revenue from LED contribution has stagnated over last couple of years. So by when can we expect more contribution from LED lighting?
Well, ma'am, on the contrary, I would differ from your statement. If you look at 2017-18, literally 5 years ago, LED was 25% of our total revenue pie, LED lamps. As on 6 months of the current fiscal, LED share is 36%. So we've definitely had an enhancement on the LED. As I mentioned, on the certain models that we had gone back from LEDs for, low cost, let's say, focus on OEMs. But given the order book having more than 80% of LED, we expect this number probably somewhere in FY26 to be close to 50-50. LED share would be probably 50% in the next, let's say, give or take 3 years, 2 to 3 years.
Got it, sir. And also I wanted to ask, with the premiumization being the theme in the auto industry, do we envisage more LED lighting supply with increasing content per vehicle?
So absolutely, I think premiumization is, so there are two things. One is the technological changes which is coming because of the segment shift towards more SUVs from small passenger cars. So in SUVs, the lamp technologies are definitely greater, more towards LEDs, more towards projectors. So that is one reason why we see the order book would have a much larger contribution per vehicle than in the past. And second, within each model, I think the premium variants are selling a lot more than the mid variants. And that's the second reason why we see that our per vehicle contribution is significantly going to increase in the times to come.
Right, got it. And my last question is, so what is the current contribution of revenue from EV business? And can you also share the two-wheeler EV customer we are working with? Like, have we signed any new age or traditional customer in the EV space?
So ma'am, the current revenue from EV specific models would not be very significant. And the reason for that is that if you look at our overall pie is still approximately 65 to 70% from passenger vehicles, where the EV penetration by itself as an industry is still low. However, in the order book of 2,200 crores, which the company is sitting on, almost 35% is from EV models, and they are more in the passenger vehicle space.
Okay, that answers my question. Thank you.
Thank you.
Thank you. The next question is from the line of Harshal Shah from AN Investments. Please go ahead. Mr. Harshal, please go ahead with your question. Mr. Harshal, your line is unmuted, sir. Please go ahead with your question. As there is no response from the line of Mr. Harshal, we move on to the next question from the line of Jatin Chawla. Please go ahead, sir.
Yeah, hi, good morning. Thanks for the opportunity. My first question is, in the first half of the year, we have done an EBITDA margin of 8.8%, and for the full year, we have been trying to get to double-digit kind of margins. So do you think that is still possible this year once the Chakan plant, which has better margins, starts scaling up, or we can get to double-digit now only next year?
No, absolutely. I think for the current year, the guidance is still intact to have a double-digit margin at an EBITDA level. And as I mentioned in H2, while we are looking at a significant revenue growth, we are also looking at a margin expansion specifically in H2. But answering to your question, full year, yes, the guidance remains unchanged.
Okay, but that would mean margins will, for the second half, will need to be north of 10 because we've done 8.8. So that's a significant, almost like a 150-200 bips improvement that we should see in the second half.
Absolutely, that's the focus.
Okay, great. The second question is similar. The revenue guidance of 20%, given that we have done 12%, for the second half, we need to do almost 28, 29% kind of growth. Is that possible, or will be a little bit shy of 20% for this year?
No, I think for the full year, I'm still looking at anywhere between 15 to 20% of overall revenue growth. You're absolutely right. For H2, our revenue growth outlook is probably north of, let's say, give or take 25%. The major reason is that we've recently commissioned the Chakan facility, and we've already gone into SOP for the XUV 700 lamps, which is a significant contribution per vehicle. And if the industry volumes continue to grow, because we have seen a strong October and November month, probably because of festive, we are looking at some probably correction in December as an industry because of the, let's say, increased inventory levels at the dealers, which is sitting. But I think Q4 again, we will see a pretty decent growth. So our growth is not just coming out of the industry volume growth, but it is also coming as an incremental wallet share expansion for Mahindra & Mahindra.
Understood. And I think in the presentation you also mentioned that you started producing for the Tata Nexon as well. So that is again being done from the Chakan plant, and is that only the ICE model, or we have the Nexon EV as well?
So we are on the ICE model, and yes, it is done on the new Chakan facility as well.
Okay, got it. Thank you.
Thank you.
Thank you, sir. Before we take the next question, a reminder to all the participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. We take the next question from the line of Harshal Shah from AM Investments. Please go ahead, sir.
Hello. Hello.
Yes,
Yes,
sir.
go ahead, Mr. Shah.
Yeah. So Anmol, my question is, Maruti has grown quarter on quarter for us, the contribution from Maruti. So, but the volumes for models that we are on were relatively flat. So have we started supplying for new models, or there's anything more to it?
So if you're looking at Q1 of current year to Q2 of current year?
Yes.
Yes, so we've had a 24% growth on a sequential quarter vis-a-vis the customer growth of 14 to 15%. It is just the product mix. Again, in the last quarter, there is no significant new model introduction, but it is just the product mix which has changed, because of which we have shown the strong growth on Q-on-Q basis.
Are we seeing the same traction again, like in this current quarter, like?
So we have to first understand the dynamics that Maruti Suzuki is sitting on pretty much full capacity today. They don't have any more capacity to produce more units. As we all know that there will be an incremental capacity expansion in the new facility of Kharkhoda only in FY25. So perhaps we are already looking at a peak in terms of the output of Maruti Suzuki. However, given the product mix dynamics, I think we are not present on few of the SUV models, which was already explained in the earlier calls. But I think we are still bullish. We are present on the Jimny, and again we are looking at a pretty incremental growth of Jimny volumes as well in H2. So I would still expect growth momentum with Maruti Suzuki for the company to continue, despite Maruti's overall output probably being flattish for the consecutive quarters.
Thank you. And one more question. We have one top-level recruitment for the Lumax group. Is it for the Lumax industry or for Lumax Auto from Toyota?
It is, as you rightly mentioned, for the Lumax group. Mr. Raju Kepkale joins us as the Executive Director for Manufacturing and Corporate Planning at Lumax Management Services, which is a company which provides corporate services for the entire group. So he is not specific to industries or technologies, but as I mentioned, his role encompasses the entire group from the manufacturing and corporate planning.
Okay. And one more thing, are there any structural issue with margins from the existing plants, or something that we can do about, like?
Could you repeat that question, please?
Are there any structural issue with margins, like from the existing plants? New plant, we are sure, like you can do upwards of 15% that we have guided, 15-20%. But any problem with the existing plants? Because we've been trying, and it's no fun working at 9% margins for you guys also. So I'm just trying to understand, like, what is the problem?
So I think there are two things. I think current plants also, we are upwards of perhaps 15% in certain plants. I think there are certain plants which are not fetching 15%. They are definitely below that. So I think going forward, we will be again consolidating, optimizing our fixed cost structures as well. Of course, new plants is where the growth will come from at a much higher EBITDA, but we will also rationalize our cost structures so that the overall company's EBITDA grows from a manufacturing standpoint. Also, we are re-looking at how we optimize our other fixed costs beyond manufacturing, be it on engineering or be it certain other cost structures. So definitely, we are, as I mentioned before, the first step is to get into double-digit EBITDAs, which we do foresee to happen in the near future. And once we are there, definitely we'll probably take the next leap forward.
Okay. And also on the subsidy amount that has been disputed with the Gujarat government. So can we not go to clients and get the prices revised? Like, how does it work?
No, so I think the clients don't have any role to play here in the OEMs. I think the OEMs are also supporting, and this is not specific to Lumax, this is across the tier 1 within the state of Gujarat. So I think this is a collective matter, and I think this is being addressed at the topmost level collectively by both tier 1s and OEMs. As a good conservative corporate governance practice, we have just decided not to book the subsidy income unless and until it's realized going forward.
Fair. And last question on the debt side, like what will be the peak debt for the company?
The debt is at 162 crores long-term loan as on 30th of September, and we are anticipating that on 31st of March, the peak would be 200 CR. The debt equity ratio at present is 0.33. It will go up to 0.35 or 0.36 as on 31st March 2024.
And full debt, like along with the working capital debt, what will be the total debt on the books?
As on date, it is 551 CR precisely. But I think the total debt going forward may be not that incremental as in long term. So the way forward, the debt should be almost around 600 around that.
Okay, sir. And sir, last thing, any update on the Pune plant? Like, how is the production going? Is it ramping up fast or like will be very slow? You mentioned 150 to 180 crores turnover will be doing, but what is your take on it? Like,
so I think I've mentioned already the Chakan plant has gone online in Q3. We are expecting it to run at almost full capacity by the end of Q4. We have already kick-started phase 2 planning, and perhaps in FY25, FY26, we will also execute phase 2, which will be further enhancement of the current capacities. And we have a strong order book where we can see probably by FY26, the new Chakan facility will also be running at maybe 80% plus capacity utilizations. So we are not looking at a incremental growth. We are looking at an exponential growth from the capacity utilizations at Chakan.
Great. And Anmol, for next 6 months, can we take like 15% margins from the incremental turnover from Chakan, like 150 crores to 15% types of margin? Or like it will cover all the cost, or that's where I'm coming from?
I would not be able to specifically give you the Chakan per se margins, but I think yes, the EBITDA margins at a plant level should definitely be looking at around 15% or give or take that ballpark figure. So I would not be having the precise number, but your estimate should be pretty much bang on.
Okay, sir. That's it from my side. Thank you, Anmol. Thank you, everyone on the call. Thank you.
Thank you, sir. The next question is from the line of Viraj from SIMPL. Please go ahead, sir.
Yeah, hi. Thanks for the opportunity. Just a couple of questions. First is on the overall sales and realization. Now, what we understand globally also there's a change in technology within LED, and that itself is also driving a moderation in LED unit prices. So can you just share some perspective for us, and generally what are we seeing in terms of the LED price trend? And when we talk about this, say 80% of the book being LED, how does the realization now compare to what it was, say, earlier?
So the LED from a pricing perspective, obviously, as I mentioned before, it's almost close to 3x of the conventional lamp. Now, depending on the technologies, depending on certain type of lamps, we're also seeing that the styling, especially on the rear, has rapidly changed, where you start seeing a linear end-to-end kind of a tailgate lamp, which is integrated with a tail lamp. So it's not just a technological change, but it is also a styling change, where the size of the lamp is exponentially increased, which also means the contribution per vehicle has increased. So there are a series of reasons why the lamp technology is yielding better contribution per vehicle going forward. In the order book also, as I mentioned, we're looking at a handsome LED penetration. So that is going to continue, because Apart from LED, as I mentioned, the projector is also another technology which is fast, being adopted on the passenger vehicles. And there are certain technologies which I cannot disclose, but we are expecting this will be the first time we will be as Lumax localizing this technology for one of the forthcoming models of an OEM in FY25-26. So there is a rapid technological advancement across the lighting spectrum, and it will definitely yield better contribution per vehicle.
So basically the question was, are we seeing any moderation in unit realization, because of these technology changes?
So definitely, I think the unit realization, as the demand of LEDs goes up, the pricing also will somewhere get corrected, but I don't expect it to be a rapid dip compared to where it is today. Please understand that there are significant components of electronics which continue to be imported in the country. And because of that, the pricing will continue to be at a much higher delta compared to the conventional lamps. There will be some correction because this will become the, let's say, technology which is mass market, but it will still have a incremental impact with respect to the conventional lamps.
Okay. And second related question was in terms of contribution margin also. Typically what we understand that in a LED versus a conventional, the contribution margin per se may be the same, but given the higher unit realization, the overall EBITDA margin is much better compared to conventional lighting. So with even what the moderation, whatever we are expecting in LED unit realization, the overall EBITDA margin expectation in the business, that doesn't change materially. Is the understanding right?
So the EBITDA margins definitely would go up, and not specifically on the contribution, because as I mentioned, the material consumption on a LED would be probably a little more than that of a conventional, primarily related to a lot more imported parts. However, as I mentioned, the 3x exponential contribution per vehicle will not add to the cost structure in the same proportion. So at a bottom line EBITDA level, definitely we will have an enhancement of the margins yielding with the new technological lamps going forward as well.
Okay, just one last question from my side. When you talk about the order book, say 80% being LED, and in that also you talked about major LED, we are getting more in the passenger vehicle. But in terms of two-wheeler, especially in the EV part, we don't hear much of traction on the win rate from our side. So is it that strategically we have chosen to focus more on, say, passenger vehicle, maybe because of higher kit value vis-a-vis the two-wheeler? Or, what is the thought process on what are the reasons behind not having a much more higher win rate or order book in two-wheeler, especially in EV?
So there are two clear thoughts on this. Number one, I think the passenger vehicle, the technological leap and the let's say material margin as well as the contribution per vehicle is far, far greater than that of two-wheelers. So, and going forward, we have, as I mentioned, a handsome order book on the passenger vehicle. On the two-wheelers, I think we're dissecting it again in two buckets. One would be the legacy players with which the company has enjoyed relationship over decades. And second would be, let's say, the new age entrants who are specifically in the EV, two-wheeler business. I think our strategy and focus is more with the legacy players. So we are already engaged, and we do have some engagement on discussions and even the order book for some of the EV models from the legacy players. So it's not that we are ignoring or we are not present in the EV two-wheeler space, but I think we are consciously choosing to go with the legacy players rather than going very aggressively with the new age entrants.
Okay, thank you and good luck.
Thank you.
Thank you. The next question is from the line of Prolin from Goldfish Capital. Please go ahead.
Yeah, hi. Thank you for taking my question. So pretty much most of my questions have been answered on you reaching double digit for the entire year. But starting with the margin part, right? What I understand is that the reason for you reaching double digit for the full year FY24 is largely the contribution which is coming from the new Chakan plant, right, which is at a 15% kind of a level. Just from your core existing plant level, what is the scope of improvement in margin? You did touch upon it, right, in some sense, but just want to understand, is there a significant scope of improvement in margin in terms of existing plants as well? And where I'm coming from is that, we did this whole insourcing of PCV, right? And all, and obviously operating leverage is also playing out. So if you can help us break down, in the core existing plants, what can be the improvement in margin that can be seen maybe FY25 onwards?
So definitely there is a opportunity to further increase the margins in the current plants. Please understand, even though Gujarat plant would also have a rapid expansion going forward in terms of the order book, and the Chakan plant, as I said, is going to be dealing at 80-85% capacity utilizations. But of course, there are significant other plants which will continue to grow. I would expect anywhere between, give or take 200 bits or upwards of that, margin expansion in the current facilities as well, which is possible from, again, operational efficiencies, from better cost management. FY25 onwards, definitely there is an upside there as well, along with the new facilities, which would come at a probably lower cost structure in terms of the fixed cost and hence yield better EBITDA margins. So clearly, I think the focus is on both current facilities improving their margins, as well as making sure that the new facilities and the new investments yield better margins than the current facilities have been yielding.
Sure. So does that mean that our new base will probably shift from 8 to 10% kind of a range to 11 to 12% kind of a range? Is that a fair assumption to make starting FY25?
Yes, absolutely. I think that's a fair assumption that we would inch forward on the margins to that level.
Okay, sure. Thank you, sir. And on this Chakan plant, right? Can you just remind us that the current facility is the part one of our expansion, right? In some sense, what is the capex that we have already spent here, and what is the capex in the second phase, and when will that be up and running?
So absolutely right. The phase one is over, which we are getting into SOP, or we've already started SOP in quarter 3. The capex outlay for phase one was about 175 crores, and we've installed a capacity of about 500,000 vehicle sets of passenger vehicles. In phase 2, which would get kick-started in FY25, we expect probably another 500,000 vehicle set additional capacity, probably a capex outlay of give or take 100 crores for phase 2. And again, the peak revenue from this facility is likely to be upwards of maybe 800-900 crores by FY27.
Okay, thank you for that. One last question would be, if I look at your Q2 numbers, and the specific line item which I'm talking about is, this profit from associates, right, in some sense. Do you want to call upon, what was the performance of this SL Lumax in the first half?
So I think I have mentioned this before. SL Lumax, we must not put too much weightage on a quarter-on-quarter basis, but I think on a year-on-year basis is something which is probably a more realistic picture. Obviously, if you look at H1, SL Lumax's revenue has grown by about 14%, and in terms of their PAT level has actually grown again by 50%. So that's only for H1. And again, from quarter 1 to quarter 2, they've had a 23% growth in their profitability, despite just a meager 5% flattish growth on the top line. So I would expect, again, to see this for the full year rather than, making some message or driving some message out of it on a quarter-on-quarter basis.
Sure, sir. That helps a lot. Thanks a lot. That's it from my side, and all the best, sir.
Thank you.
Thank you, sir. The next question is from the line of Dhruv Bhatia from Bank of India Investment Managers. Please go ahead, sir.
Hi, good morning, and thanks for the opportunity. My first actually is just a clarification. You mentioned that H2, you kept mentioning 20 to 25% growth. Sometimes you mentioned 25% plus revenue growth. So could you just, reiterate second half, what is the revenue growth that you are expecting so that, to achieve your 20% growth, you require, as you said, about the run rate is 29%. So should we look at a 20 to 25% or 25% plus growth in H2?
So in H2, just to re-clarify, we are looking at upwards of, let's say, 22 to 25% of growth for H2, which means that for the full year, we should be looking at close to 18 to 20% growth.
Okay. And just to also understand on your order book mix, you mentioned, the new orders. Could you also mention the bifurcation of headlamps and tail lamps in this order book? Because my understanding is headlamps is a far more profitable piece versus tail lamps.
I would not have that breakup immediately on the head versus tail as of now, but again, I am not sure if that is correct, that headlamp is a more profitable business. Definitely the headlamp contribution per vehicle because of technology is greater than that of tail lamp. But given the fact tail lamps also would be a higher profitability, I think for us in H1 almost 60% plus is coming from the front lighting, and almost the remaining is coming from rear lighting and miscellaneous lighting. In our order book, we also have some strong order book of tail lamps. So I do expect our share from tail lamps to increase going forward as well.
Sure. And just also on the overall cost structure, because for the Chakan plant, I think in the last call also you had talked about that you had already hired employees and already the investments were made for as you were commissioning the plant. So this run rate of quarterly employee cost run rate currently of 80 crores is something that we should work on for the second half as well, or will it materially increase in the second half?
So I am still looking at the manpower cost to be anywhere between 12 to 13%, which would be on a sustainable basis. There are certain incremental impacts because of wage agreements and the annual, appraisals and inflationary costs. But given the fact that, these new facilities will be at a better cost structure, we should be able to maintain the overall percentage manpower cost as a percentage to revenue.
And the Chakan facility, you would also mention H2 sales that you're expecting will be 150 to 190 crores, or is it the entire, phase 1 will be 150 to 190 crores?
No, this was only for H2, which would be close to around, give or take, 170 to 190 crores for H2. So if you annualize that, you're looking at almost close to about 350 to 400 crores of revenue on an annual basis from the new Chakan facility.
Okay, so because, if I just do a rough calculation, a quarterly 750 crore of revenue run rate will bring you to an 18-20% full year growth, which means on a 650 odd crores of sales that you're doing on a quarterly basis, large part, or I think almost 90% of that will incrementally come from Chakan.
That's correct. I mean, for H2, our incremental growth is largely coming from Chakan. That's correct.
Sure. And just two more questions. One on, could you talk about the, components which are getting imported and, what is the percentage, and are you seeing any, inflation in any of the raw materials that you are sourcing?
So as of now, I'll take the second portion first. On the raw materials, we are still being able to maintain the raw material consumption, give or take at around 65.5%. We have recently started to see certain price increases on certain base raw materials globally. I do expect some impact of that probably in Q3 and Q4, or let's say in H2. However, most of that, as I've always mentioned, we do try and get it from our OEMs. There may be a 1 quarter lag, but we do recover these price escalations from the OEMs. Coming on the imported electronic parts, as I said, the PCB is locally assembled. So we have a local manufacturing or assembly of the SMT or the PCB, but the PCB board by itself, along with all the electronic components which go on the PCB board, are largely still imported. And we do expect with these technological changes happening at a very rapid pace, these will continue to be imported for the, at least foreseeable future. We do have a strategy, or we do have a team working on localizing this, but I think that would be in second step. Once we are able to establish the quality, establish the engineering capability with these parts, then we will look at localizing these parts. But these are typically the small capacitors, resistors, and certain other small components which go onto the PCB.
So of your cost of material, just on that, is that, of the 65% cost of material, what percentage is actually imported at this moment?
About 50% of that, give or take.
Okay. And just the last question on the tax rate, obviously we are at a much higher tax rate. When do we go back to normalized tax rate, which is the corporate tax rate of 25%? And on that, I see that you are paying somewhere about, the P&L tax is about 22 crores and the cash tax is about 10 crores. So how should we, consider that going forward? Because just to understand from cash flow point of view.
Yeah, this is Naval Khanna. I would like to answer this question. We are covered under MAT. So because of MAT and because of the taxation rules, once the MAT credit is extinguished, we will be changing it to the new rule.
So just when will that, when will you
extinguish the MAT? It is expected to be in the financial year 26-27. That is assessment year 27-28. Of course, it will depend upon the profitability of the company and if there are any further modifications in the tax law. But as of now, the company is covered under MAT.
So you will be at 40% tax rate going forward for the next 3 years?
No, not 40%, because effective tax rate that way comes to around 27%. So we do take credit of the income tax depreciation. We do take credit of the allowable allowances. So effective tax rate that way comes to approximately 27%.
Okay. And last question is on the Chakan facility in H2, because I think there is some subsidy benefit that you will get at the Chakan plant. Are we expecting to, receive any subsidy gains in H2 from this facility?
I'll let Mr. Sanjay Mehta answer that, but just before that, Mr. Bhatia, just a correction on the imported piece. It is actually 1/3 of the raw material consumption and not 50% of the raw material consumption which is imported. So I'll let Sanjay Mehta answer the subsidy part now.
So we are applied for that subsidy and expecting to have that in February or March, maybe the last quarter of this financial year or the Q1 of the next financial year we will get it.
Understood, sir. Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Dhiral Shah from Phillip Capital. Please go ahead, sir.
Yeah, good afternoon, sir. Thanks for the opportunity. Sir, as you are standing at the order book of 2,200 crores, so what is the execution timeline for that?
So almost, let's say 20% of this will get realized in this year itself, FY24. 60% of it will be in the next financial year, FY25, and the remaining 20% would come in FY26.
Okay. And so since we generate almost 65% of revenue from the passenger vehicle side, if you can check what percentage of revenue comes from the SUV segment?
We would not be having that data immediately, what percentage of the revenue is coming from SUV, but I think, in due course, we could share that data as well.
Sure, no problem, sir. Sir, any guess on the incremental order book side? What is the share of SUV, if we have that data?
I think on the four-wheelers, we have about 70% of the order book is in the four-wheeler space. And I would say a large part of that would be from the SUV segment because please understand the new model launches from almost all OEMs are more focused towards SUVs because that is the trend and that is where the market is shifting. So, when I say 70% of the order book is in passenger vehicles, I would say a significant part, probably maybe 2/3 of it would be in the SUV space.
Okay. And so any particular reason why our base business will not grow in H2 because majority of the revenue you are talking about will come from the Chakan plant? So any reason why our base business will not grow at the decent pace?
What business? I'm sorry. There's a lot of background noise. I could not understand what you said.
Sir, as you are talking about that incremental growth for H2 will come from the Chakan plant, which is a new plant. So any reason why our base business will not grow at the decent pace?
Well, as I mentioned, the base business, you have to look at the industry overall. And again, passenger vehicles, which is still about 65% of the company's revenue, most of the OEMs are still, except Mahindra and Mahindra, where again I'm saying that in H2 we will see an even stronger growth of our presence in Mahindra and Mahindra because of the new XUV 700 commercial production. But if you look at Maruti Suzuki or if you look at Tata Motors, you will see that there is a flattish growth on a H1 and probably in H2 also there will not be a significant incremental growth because of capacity limitation. So at an OEM level, I think they're churning out to their peak capacity, and that's why our growth is only coming from a product mix change. But in Mahindra, we have added a new model to our product portfolio, and that's why you see an incremental growth coming in. Of course, we've had significant growth in Toyota as well as MG Motors, but again, the overall numbers still remain low compared to the other OEMs.
Okay, understood, sir. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Mr. Abhishek from Dolat Capital. Please go ahead, sir.
Thanks for opportunity again, sir. Sir, your effective tax rate is around 47% in first half FY24. And you are talking about that effective tax rate would be around 27% after deducting all other benefits. So, what assumption we can take in terms of the effective tax rate for FY24, full year FY24 and 25?
Mr. Khanna, would you like to step in and answer that, please?
Hello. Yeah. Hello.
Hi.
Yes, go ahead, Mr. Khanna.
Am I audible, please?
Yes, please go ahead.
Yeah, so effective tax rate for us comes to about 27%. That is what I mentioned after taking all the allowances and the depreciation benefit. However, since we are under MAT, there is no cash outflow. So the MAT credit which is available with us is expected to be extinguished or utilized in the next 1 or 2 financial years. That is what I meant to say.
So we think the effective rate which comes in the financial year on 30th September is the 34% after considering the deferred tax and all this. Mr. Khanna is talking about purely for the income tax outflow considering the MAT tax.
So 27% is net of the deferred taxation. Deferred taxation, as you know, is the credit and debit of whatever asset utilization is there. So net in this quarter, if it is 34%, in some other quarter it will be less. That is the thing of deferred tax. But effective tax rate, net of it, effectively comes to about 27%.
So can we assume that in FY24 that tax rate would be around 27 to 30% of the PBT?
Yes, you can assume like that.
So in the first half already we have done around tax of around 47%. So in the second half it would be much lower side.
Yes, because there will be some capitalization of the assets which has not taken place, because one of our plants has been put to use on November 1st only. So those all will be considered for enhanced depreciation, etc. And net taxation is expected to be in that range, about 27 to 30%.
Okay, so we can assume that the effective tax rate would be higher, 1 or 2% higher than the corporate tax rate. That is around 25.4%. Okay, sir. Thank you, sir.
Thank you. The next question is from the line of Jatin Chawla from RTL Investments. Please go ahead, sir.
Yeah, hi. Thanks again. Just a quick clarification. So Hyundai has recently bought the GM's Talegaon plant. Will SL Lumax continue, will supply to that plant also, or do they have some other plans for the western region of the country?
No, so SL Lumax will definitely continue to provide its services to Hyundai in Talegaon as well. They are currently evaluating the feasibility of perhaps setting up an infrastructure near Hyundai in Talegaon, or perhaps utilizing some of the infrastructure from Lumax. So that discussion is ongoing with SL Lumax, but the order book for Hyundai's Talegaon will continue to go with SL Lumax.
Okay, so but there is a possibility that Lumax Industries Gujarat plant might be supplying to this. No, sorry, the western plant, not Gujarat plant.
It may not be supplying the entire land, but if we are able to have certain surplus capacities being utilized for Hyundai's end production through SL Lumax, we are evaluating that. But also SL Lumax will continue to evaluate investing in a facility in Talegaon for meeting Hyundai's needs.
Okay. Because, Hyundai has been constrained for capacity. So once this new plant comes, there will be a decent increase in their capacity. So for SL Lumax also, should we expect that once the new plant comes in, I think they're talking about early 2025, we should see some uptick in their revenues?
That's correct. I think FY25 is probably just SOP, and I think the real peak revenue or the peak volume realization of Hyundai is expected in FY26.
Okay, understood. Thanks a lot.
Thank you.
Thank you. We take the next question from the line of Sunil Kothari from Unique Asset Management. Please go ahead, sir.
Thanks for the opportunity, sir. Sir, my question is basically we aspiring for a double-digit margin since long. We reached there sometime when again we come back to below 9. So would you like to comment qualitatively which are the challenges that we are not able to sustainably keep a 10% plus margin, which our aspire is, I understand, 12-13, but in this first half also we are below 9. So if you can talk a little bit on more.
So Sunil, thank you very much. I think there are few areas of focus clearly. I think number one, on the raw material side, we continue to have a very strong focus to try and reduce the raw material consumption. We have, let's say, if you look at Q1 of the last financial year, FY23, and if you look at the current quarter, FY24 Q2, you'll see that the raw material consumption is up by about 1%. Now, this is largely on account of product mix, but our endeavor is consistently to reduce the raw material consumption. And as I mentioned, with new technology, the raw material consumption tends to go up, but we're working very hard to make sure that this is at least maintained and further reduced. I think second, if I look at the overall, the expenses are definitely balanced. They are in control, around 14.5% to revenue. But there clearly is always an opportunity to further optimize and save on the costs on both the other expenses as well as the manpower. I think there has been certain manpower costs which have been in the Q2 escalated because of the commission of Chakan plant going into Q3 and typically we hire about 3 to 6 months before to train these associates on our existing plants. So there is a duplicacy of cost structure without having a realization on the revenue. So these are fundamental reasons, but I think overall we are looking at operational efficiencies. We are also looking at with incremental revenue growth, our fixed cost structure should get more rationalized. So I think these are some of the key focus areas, and I'm pretty optimistic to not just achieve double-digit margins in a particular quarter, but also to then thereafter sustain it and then look at ways and means how to grow it forward, as I mentioned, to 11 to 12% marks.
Great, sir. A very good, detailed explanation. So my second point is, say now onwards it seems to will be at a better margin, generating better cash flow because we have depreciation also very, very heavy. So our capital allocation policy will require some debt repayment also within a year or two, or yet we want to do a major capex continuously?
So I think for the order book, I am not envisaging any substantial capex. I think going forward, the asset turns, which is currently around 1:1.7, I think on the new order book that should substantially improve for two primary reasons. Obviously, one is the contribution per vehicle is higher, and number two, because a significant part of the capex has already gone in the current year with respect to the Chakan plant. So I think going forward, we are very comfortable with our debt equity ratio, and I think we will continue to maintain it in a similar fashion, about 0.35 or so.
Okay. So sir, this 550 crore currently, which Sanjay has clarified, should we consider maybe 25 crore plus minus will be the peak debt?
Yeah, around 600 crores could be taken as a peak debt figure for working capital as well as long term.
Right, sir. And one small question is, you expect any growth from the contribution of SL Lumax year on year?
Well, again, difficult. If you look at SL Lumax, I mean, of course, Hyundai has done reasonably okay in H1 versus last year to this year. But again, in H2, they, as I mentioned, would be struggling for capacity. So this is something which I will have to look at from a full year perspective. But again, if you look at the quarter 1 to quarter 2, there is only a nominal 5% increase. So I think it would be probably single digit only, which is what my best estimation would be for the full year.
Yeah, because half yearly we grown almost 50% contribution, share of profit from associates. That's why I'm trying to understand. Last year we got 41-42 crore. Is it possible to achieve those, or it seems difficult?
No, I think that should be reasonably okay because we've achieved about 24 crores in the first half. So I think the 41-42 crores should be definitely something which we should expect for the full year.
All right. And sir, last question is, next year you are, I think, just I'm reconfirming, a growth rate of around 20%?
Next year in FY25?
Yeah, 24-25.
Yeah, I think we should be definitely looking at that kind of a growth, both because of the new order book as well as certain organic growth. We would have only done Mahindra XUV 700 for H1 in this fiscal, so that also annualized impact will give us a growth for FY25.
Great, sir. Thank you and best wishes.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to Mr. Anmol Jain for closing comments.
Well, I would like to thank everyone for joining on to the call today. We continue to remain confident on the growing prospects of India and particularly the automotive sector. I hope we have been able to respond to your queries adequately. For any further information, I request you to please get in touch with SGA, our investor relations advisors. Thank you once again, and I take this opportunity to wish all of you on the call today and your families a very happy Diwali. Please take care.
Thank you. On behalf of Lumax Industries Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.